Hello everyone, welcome back to the channel. Best place for long-term stock investors. How's everyone doing?
Yep.
And today is our second time we're doing this. We still have not decided our name, so please, more names in the comment section to tell us what this thing should be called.
Yeah.
Right?
Is it spark our ideas? Yeah.
Weekly? I don't know, man. So anyway, we're going to talk about three things today, right? The first is Top Glove's recent quarterly results. What do we think of it? How we think good investors should think about it. So that's one. Then we talk about Hibiscus. No, not the flower, the oil and gas company. They recently bought another company. So that's going to look very interesting.
Yep.
And then last, we'll talk about, probably, I think the second most actively traded stock in Malaysia as of the last week, which is Dagang Nexchange or DNEX. Or for some of you old-timers, Time Engineering.
Yep. So, you want to get started on building your 6 to 7 figure portfolio? We have a free training lineup and you can find the link in the comment section below.
Right, John. So let's just start with Top Glove, right? It was the darling last year.
Correct.
This year, not so darling anymore for obvious reasons.
Turned into an ugly duckling and what, swan, is it?
Yeah. Swan become ugly duckling. So on the 9th of June, Top Glove announced their quarter 3 report. And from about last year, compared to last year, at the same time, they made like 350 million. And then today, recently they made 2 billion.
Wow.
So that's huge. Then in terms of the year, right? If you do a year-to-year comparison, year to date, 2020 was 577 million. Today, 7.3 billion.
Wow.
So that's like how many X, man? That's like more than 10X. That's
correct.
15X, But of course, I think the question we all want to know, I think investors all want to know as well, is that these are what we call lagging indicators.
That's right.
This is something that the market has already predicted about 6 or maybe 1 year ago.
Yeah.
Right. So I think a lot of people, some of you all listening might be a shareholder of Top Glove.
At what cost? At what price do you get it,
maybe you bought it a bit high. Maybe you bought it at 7. Right now the stock's at 5. As you can see, right, even though the results was announced, yes, there was a spike up. I believe it's how many percent spike is this? Apologies. Yeah, so it's only a 4% spike, right?
Yeah.
Because of the news.
But the ADR actually jumped quite a bit on Friday, remember?
Yes, for those who don't know, ADR is the American or the American one, right?
Yeah.
So what are your thoughts? What do you think of the recent quarter?
I think the price has already been baked in, and as what you rightly pointed out, a lot of people are already forecasting this profit will only be temporary, and going forward, once the COVID pandemic actually dies out, then things will flatten out.
Right.
And I think as investors, and I think we covered this very insightfully in our deep dives. The two things that you need to look for is production capacity increased by the other competitors, as well as the ASPs, the average selling prices for gloves. Now, I think one thing that Top Glove actually highlighted in their press briefing was that production lead time has actually reduced. So right now it's anywhere between 90 to 120 days, depending on type of gloves. Right. That's the first thing. From pandemic peak days, January till March 2020, you're looking at about 300 days.
Wow.
So it's come down by almost half, right? I think more than half. Pre-pandemic, it was anywhere between 20 to 30 days. So you can imagine, what I think a lot of even retail investors on the street already know is that it's going to go back to normal.
How should an investor understand production lead time? Like, what does it mean?
Means the point where you order until when you're going to get it. So the longer it is, obviously, then because of demand high, then production capacity cannot meet, right? Correct. So the shorter time frame reduces the supply and demand balance of prices.
Sure.
Yeah, and I think where investors should be looking at is actually what will be the normal growth rate without the pandemic.
Correct.
And I think Top Glove came out with a number anywhere between 8 to 10%.
Correct. I think Harta Lega thinks it might be 12 or even 15.
Okay.
Right. So I mean, it depends who you ask.
Correct.
Right?
Exactly.
So, I mean, it's basically around there. And I think in terms of demand, Actually it's pretty high. Honestly, like I think at the average business maybe grow like the average business over time grows maybe about 6% a year.
Yeah, that's right.
Right, because that's pretty much the stock market returns if you buy an ETF.
That's
so
right.
roughly that's what you get.
Yeah.
I think what is interesting to note and why gloves are slightly easier to understand is mostly because the demand side of the equation is a lot more fixed. So you don't have to think like, will people want the product?
Yeah.
Of course, right? Unless everyone, don't have fingers anymore,
Yeah.
That's my joke. But I think one thing we can talk about as well is that is the supply, right? And my thoughts on the supply is that I think China is coming up big.
Oh, yeah.
China is coming up big. And, last time when people were just doing rubber gloves, it wasn't so much of an advantage. Malaysia had an advantage. Because rubber gloves is, rubber is only found in this part of the world.
Correct.
And in China, they don't have the requisite temperature or weather for it.
That's right.
Now with nitrile, because it's butadiene.
Yeah.
Right? So a country as big and as powerful as China will be able to do it.
Just build petrochemical facilities.
Yeah, exactly. And so I think it's giving Top Glove a run for their money.
Correct.
And in fact, the closest competitor, Inco, if they achieve what they achieve, they should be bigger than Top Glove. If not 5 years, 10 years.
That's right. I think when we did our deep dives, I think the Chinese players, Blue Sail and Inco, had the biggest growth in capacity going forward, the forecasting.
Right.
I think it was, on average, was about 60% growth.
Yeah.
Yeah. I mean, comparatively, compared to the Malaysian players, they've been growing organically about 10 to 20% kind of capacity. So, yeah, China will be something to look out for the supply and demand imbalance.
But here's the interesting thing, right? So I think there's one camp that says, China's going to rule the world. And, I don't blame them for thinking that because, if the Chinese put their minds to something, they're going to achieve it, right?
Yeah.
And this is, glove manufacturing is manufacturing. And there are very few companies in the world, very few countries in the world can do manufacturing better than China.
Correct.
Right? But I think just to not bring that theory to the extreme, I would say that Top Glove and all these Malaysian players still have a big advantage.
Oh,
What do I mean is that they already have FDA approvals. They are already friend with the US, right? They have that labor issue, but happens all the time, right? It's easily resolved.
Yeah.
By the way, I think my thoughts on the labor issue is that it's a small thing. I could be wrong, right?
Yeah.
Like, it could come back to bite me, but you know, I think it's a small thing. It'll be resolved. But I think with the relationship between the US and China, I'm not so sure, especially when it comes to healthcare products.
Correct.
I really am not so sure whether or not Inco will make any inroads. So I think that's something to take note of. Do you have anything else you want to
No, I think I think most importantly, glove won't go away. I think that's something that a lot of investors, I know a lot of investors actually bought at the peak, and I think they are looking for ways or strategies of what to do next.
So what will you do if you bought it at 7, right? Let's say you bought it at
7.
Now it's
peak,
now it's 5, right?
Yeah, now it's 5. I think whatever dividends they're paying, I think they're paying good dividends. Either you stick it out in the long run, average down using the dividends that you have, and make sure it doesn't exceed your portfolio. Or if you can't wait, I know some of you guys here, value investing 5 years, it's not for me, right? Look for something else interesting that if you can't wait, so it's the choice is really yours. I mean, this
totally agree.
Yeah.
If you're enjoying the video so far, remember to give it a like, comment, subscribe, click on the notification bell so that you can support videos like this and you know when they come out fresh for you. Okay, next, hibiscus. For those who don't know, hibiscus is not a flower. It is actually a upstream company in the oil and gas sector in Malaysia. So briefly, what they do is they buy existing platforms, oil platforms, or sometimes they call it brownfield platforms. Basically, what it means is that it's already proven, right? These platforms can produce oil. Guys, it's not so easy to find oil, right? They actually have to do a lot of research. And even if, in theory, there is oil, that doesn't mean that they'll be able to extract it, right? That's why you need all the engineers to be able to suck it up. Now, what is interesting is that recently, early June, they announced that they'll be acquiring some assets from a Spanish company called Repsol.
That's right.
Right, for 212 million. And so what this hibiscus does is that it raises money, right? Raises through debt or maybe through equity like rights issue and all that.
Yes.
Recently it raised 2 billion ringgit. Half of that they've used for Repsol. right? And that's their strategy. Why they are able to do what may seem on the outside like a very risky strategy is because when they take a loan, right, they just tell the banks, hey, these are proven assets.
Yeah.
Confirm got cash flow, confirm got money.
Correct.
Right? So then the banks will presumably give them decent rates and allow them to take a loan.
Yeah.
And so it's not as risky as people think. But John, you know, being the oil and gas expert, what do you think of this acquisition?
I think it's very positive for them because they virtually doubled their capacity overnight, and they don't have to take capex risk because
Yes.
I think Ben Graham actually and Warren Buffett actually had this style of investing called cigar butt investing.
That's
So
right.
this is very similar to a cigar butt.
It's a
Yeah,
cigar
it's
butt,
a very cigar butt. What I do want to point out is this: even though they've bought it at 212 million for an increase of about 9,000 barrels. Let's benchmark it against another recent acquisition, which was Sapura OMV actually selling off their assets. So Sapura OMV actually sold off their assets for 9 million, and it was producing 6,000 barrels a day. So you can see 6,000 barrels selling for 9 million, and then here you have Repsol selling 9,000 barrels for 212.
How come, man?
Yeah,
Did Hibiscus get conned?
Yeah, the Hibiscus get conned, or was it was it overvalued? Actually, it all boils down into this thing called abandonment costs.
Right.
Because if you guys are not familiar with production sharing contracts, what you have to do is the moment you finish sucking up all the oil, you got to plug it and return or restore the platform back to its normal state. So what does abandonment cost actually look like is that they have to really actually have to chop off the whole platform, plug the well, and restore it back to normal. And it's very costly. And the reason why Sapura managed to sell it on cheap was because probably the abandonment cost was more than how much the guy who is buying, the amount of net profit he could actually generate.
Right. So, I mean, to better explain abandonment cost, the way I see it is like, you know, if you eat food already, please clean it up.
Yeah.
Right.
It's like McDonald's, you have to clean the tray.
But it's a very expensive one. Roughly how much in your experience will an abandonment cost?
Okay. So rather than using my opinion, I use Hibiscus.
Right.
So Hibiscus actually have two main producing assets, which is in Anasuria in the UK, as well as the North Sabah assets. Okay.
Right.
The abandonment cost on their books today is roughly about 400 million.
400 million.
Yeah.
I see.
Yeah.
Okay.
Yeah. So it really depends because there's many variables in place, how many platforms and all that. But you can get a gauge by looking at the actual numbers that's Hibiscus has actually put.
So as a result of this announcement, the company has risen, the stock price, right? As you can see here, it has risen about 15%, which is very interesting.
Correct.
And what this company reminds me a little bit about is Yinsen.
Yeah.
Right? It's not exactly the same.
Yes.
It's not, in my opinion, it's not as good because Yinsen does not really have an abandonment cost at the level of Hibiscus, right?
Correct.
Because Yinsen is, you know, just drive boats, basically.
Yeah.
I know I tend to oversimplify it, but you know, basically.
No, but it's good. It's oversimplification is good.
Yeah, so no, simplification is good. Maybe not oversimplification. So, so anyway, in terms of the strategy, in terms of also like PSC blocks, right? How many PSC blocks are they getting as a result of this? And what are some of the key blocks that you would you think are worth mentioning and are quite interesting?
Okay, I will start with the ones that are going to expire the fastest.
Right.
I think PM305 is going to expire in 2020. No, I think the North Malay Basin is going to expire in 2027. So you're talking about what? About another 6 years?
6 more years of juice.
Yeah, 6 more years of juice. But it all goes to play because the other partner is actually Petronas.
Right.
So they technically they can actually go back to not the Petronas, their partner, which is Carigali, but more the Petronas management unit.
Right.
That actually dishes out this PSC and say, hey, we are putting in new equipment, we're spending more money, we want to extract and extend the field life. That PSC may be up for extension. And I think that's what Hibiscus is trying to do. Really squeeze out the most out of the field before its end of life.
So it's like 7 years, right?
Yeah.
And let's say it ends just nice at 7 years, right?
Yeah.
Like in year terms, right? What would the cost be? Like the amount of money they make through that 7 years, how many years will be taken away for cost?
Okay. Rather than using that angle, what they do is Hibiscus has this regime where any project for what we call production enhancement,
Right.
the IRR target is roughly about 15%.
15%. So double every 5 years.
Correct. Correct. So I think it's quite good fiscal discipline from the management. Yeah, and I think looking at their operating costs discipline for the North Sabah and Anosura, right? So today is roughly about $60 a barrel.
Right. Okay.
They've constantly kept it about 15 to 18, below 20. So can you imagine? Of course, they're not going to take the full 40 because then you have to go into the petroleum tax and all that. I'm not going to go into that right now.
PITA, yeah, which is like 38%, right?
Correct.
Okay, anyway.
So, what is more important is you look at the cost, the operating cost per barrel. That is a clear indicator to know whether they have that fiscal discipline or not, and they have demonstrated it. Yeah.
Right. So now, if you're a shareholder, right, like disclaimer, I'm not a shareholder. John,
I'm not.
You're not a shareholder, right?
Yeah.
So, but if you're a shareholder or if you're thinking of acquiring the shares, right, what do you think of the stock right now? Basically, like, do you think it's cheap enough, or is it attractive? You use the word cigar, maybe expand a little bit on that.
Yeah, I think it's pretty attractive. Obviously, I don't have skin in the game.
Yeah,
right. But what would make me, if I'm an investor, more convinced is I want to look at two things: abandonment costs of the new fields that they acquire, and try to put it into my model to see whether it's worth it. And then the second thing is watch out for the operating costs going forward.
Right.
Because right now, they are mainly an oil operator. But with this new acquisition for Repsol, they have become somewhat of a net gas because their current gas is roughly, production is roughly about 9 billion. Let me double check the numbers. Yeah, roughly is about 9 billion in terms of reserves.
In
gas.
Including the recent acquisition or before the acquisition?
So before is 9 billion standard cubic feet of gas reserves. But after the acquisition, it will be 93. So it's 10 times. Yeah. So from mainly oil, they now have to manage oil and gas. Their 2P reserves for oil didn't really increase much. It was from 46 prior to acquisition, 67 post-acquisition.
Right.
So it increased about 50%, I think. Yeah, roughly about 50%.
Right.
But the gas really increased. So what we need to look out for is how well they manage gas fields as well. Are they as disciplined? It's not too much different, but it takes slightly different skills, I would say.
I think the big risk for me is that I think you need a smart guy to run it.
Oh, yeah.
Right? Because you need to, first of all, you need to raise capital.
Yeah.
And
raise capital efficiently.
And then you raise capital, then you need to manage it.
Correct.
So you need to consistently find all these brownfields, which is not too difficult to find in Malaysia.
A lot of companies are exiting. Exxon is also exiting, but it's too big for, I think it's too big for Hibiscus to swallow on their own. It's about $3 billion US on sale. Yeah.
Exactly. So that just means that if they want to get like a $3 billion US, that's about 12 billion.
Yeah.
Right, 12 billion is like nearly 10 times their market cap.
Correct.
But I do think that's possible. But as you can see, that is the risk, right? The risk is precisely that, they cannot make a mistake.
Yeah.
That's what I think. If they choose a wrong field or whatever, they do some sort of miscalculation. That's it. And so I think that is the biggest risk.
Yeah, and I think they lower that risk by buying into really brownfields rather than doing it at the earlier exploration stage.
Correct.
Yeah.
So that makes the company interesting.
Correct.
But, we all need to know what's good and what's bad.
Correct.
Okay, finally, now we talk about Dnax. Right, this is a stock that has been on many Malaysian investors' mind. Why? Because recently, Foxconn, which is Apple's largest contractor, largest Apple, iPhone and all that, bought a 5% stake in Dagang Nexchange.
Correct.
Right. And the reason is because, I don't know whether it is because of or it is assumed that because Dnax managed to acquire Siltera a few months back.
Yeah.
Siltera is a wafer foundry, very crucial for the semiconductor industry.
Correct.
And actually, Hon Hai Precision or Foxconn was actually one of the bidders, and they lost out.
That's right.
Right?
That's right.
So, hey, if you can't beat them, join them, right?
Or take a stake in them.
So now they're taking a stake in Dnax, and this really, made it the stock price for Dnax quite crazy.
I think 20 cents all the way to, how much is it now?
Yeah,
80
like
cents?
from 20
4x
cents in January lah. 20 cents in January.
Yeah.
To all the way to like it's a 300% increase. But I don't think it's because of the Hon Hai Precision.
Yeah, I think a lot of people bought in was because Siltera, yes.
Because of Siltera.
Yeah.
And then now then Hon Hai also bought into the hype. Just like us retail investors.
Yeah,
right?
exactly.
So we're not shareholders of Dagang Nexchange,
Nope.
but certainly I think because of the price movements, it certainly got us interested.
Yeah.
Right. So John, what do you think?
Dagang Nexchange, very storied history.
Yeah.
I think they are more known as a software company. 31% plus, I think cybersecurity, another 7%. So you're talking about a good 70% of the revenue is actually generated from software.
Yeah.
What's actually interesting and related to what we talked about earlier, which is Hibiscus, is that they're actually into oil and gas as well.
Everything.
So Dnax is kind of like a conglomerate, like a Sime Darby or the what do you call it, YTLs of Malaysia. So they're into IT software, and they're also into oil and gas, and quite a big chunk because 20% plus another oil field services, another one, so it's about 21%.
Right.
Through this stake and in Ping Petroleum, which actually owns Anasuria as well. The Anasuria field,
So they are linked to Hibiscus also.
Yes, exactly.
I think cool fact is that they used to be called Time Engineering.
Oh yeah, correct.
Right, Time.com, right, our internet service provider used to be under them.
Yeah.
Then they spun off, right?
Spun off, yes. Yeah, the engineering arm. So it's pretty interesting is because mainly a software guy, mainly an oil and gas guy, and then all of a sudden start branching into semicon. And not branching at the bottom, So it's like you're not even the EMS or the OSATs, You're going straight right up to the value chain, which is the wafer fabrication.
Well, what is a comparable company for Siltera?
TSMC.
Wow, guys.
Yeah.
Now we got MMSC, right? Malaysia Semiconductor.
Correct. But TSMC is more renowned for cutting edge wafer foundry technology. So I'm going to oversimplify here.
Sure.
TSMC, they are very renowned for 300mm and 12-inch wafers, which is very low nano count, which is 5-7 millimeter nanometer kind of count for their chips, which goes into a lot into your phones. Siltera hasn't got that kind of technology. They are more into the 200mm wafer space, which is 8 inches. Now, it's not to say they are dinosaurs or antiquated.
How many generations is that behind?
You're probably talking about 5 to 7 generations behind.
And one generation takes how long to?
Easily about 1 to 2 years.
So they are 15 years behind.
Yeah, easily about that.
15 years, yeah.
But they have a niche space.
Okay.
In the sense that what they manufacture, their foundries actually manufacture is this thing called MEMS or microelectronics mechanical systems. So I know it's a mouthful, it's a jargon. Think of it as, your speakers today so you need to transfer digital signal out to analog. And only through MEMS you can do that. Because if not, your earbuds, your AirPods and all that, right? All these are actually MEMS. Fingerprint sensor. I think in the latest BMW car, if you know, there's this thing called a gesture motion sensor. You move your music not by pressing the screen. You do this.
I think you can do it for your cars as well. The car door, right?
Yeah, you can just like
wave it and then you'll be able to unlock it. Yeah.
Correct. So all these MEMS actually play a very big part, and this is where Dnax actually, Siltera, actually chose
Dnax acquired
chose to niche in actually.
Right. I think I like to look at it from this angle as well. Is that why is Foxconn so interested in Siltera?
I think the current demand for semicon has just went through the roof.
Do you think it's the fact that, and this is what I think, this is a wild theory, but I think it's the fact that maybe they're not quite happy that TSMC is so dominant, right? I think that maybe they want to move a higher value, because I know that what they do is not as high value, right? Like TSMC, they have about 50%, 40-50% margins, but certainly Foxconn is nowhere close, it's sub 10, I think.
Yeah, correct.
And if I'm in the position of Foxconn, I'll be thinking, right, hey, what if I buy a stake first? And this might excite the next shareholders, but perhaps a future acquisition, a full-on acquisition, right?
Yes. I think it's a great angle, and I'm aligned to that. The other angle, which I think where they're interested in, is this. As you rightly pointed out, they are right at the end of the value chain, which is the EMS. They are component manufacturing.
There's a sweatshop of the semiconductor industry. Right?
Exactly. They assemble all these kind of things. And by going upstream a little bit more, what they can, in theory, secure security of supply.
Right.
Because they cannot run away from TSMC, because TSMC will make what we call the logic chips. But because Siltera is niche into MEMS, right? So it's kind of like complementary, not really going against TSMC. I doubt anyone can challenge the big three, Samsung, TSMC, and Intel, in terms of logic and memory, right? Memory, then the microns and all that. But really, it's like all these MEMS are actually coming out, and I think that's where Hon Hai is going towards, trying to secure chips for the MEMS instead.
I see.
Yeah.
So from the perspective of Dnax, right, when they acquired Siltera, what do you think is their reasoning behind doing that? And before I'm not saying that it will happen, or rather before a potential acquisition, straight up acquisition from, let's say, Foxconn on Siltera eventually, right? Or maybe the whole of Dnax.
Yeah, correct. I don't think they'll be interested in the next other businesses though.
Oil and gas company.
Yeah.
But from Dnax's perspective, right? I'm just trying to figure out how does Siltera actually fit into what they have now, because they're in software, not quite related to Siltera. Then oil and gas, not quite related. RFIDs also not quite related. So what help me out here.
I think it's probably national interest. Because if you go back in time and you look at the history of Siltera was a brainchild of Mahathir's era, actually.
I see, okay.
And they wanted to somewhat be part of the Silicon Valley chain in a way. And they wanted that IP to be developed in-house. That's where you see it was, I think, during the same time as the Multimedia Super Corridor.
MSC,
Yeah, so you've got IT infrastructure, broadband services and all that, but this was more into the semicon space to complement what was already in Penang, which was more the OSATs, the IDMs and all that. I think that was one of the reasons why likely Dnax won, because it had a foreign partner in CGP, which is a Chinese-based PE firm, but a majority, 60%, is still owned by a local company, which is Dnax. And just to give a contrast, and a very good question, to the selling price of Siltera. So there was a recent selling of a wafer foundry. It was actually called Global Foundries, which is in Singapore. Their plant had a capacity of about, if I'm looking at the numbers right, 46,000 pieces of, no, I think it's less, 36,000 pieces of wafer a month, right? But they sold at 3 times the price. 3 times the price of Siltera, which has a bigger production capacity. So if I'm looking at this right, I think, I plotted in my screen, 46,000 pieces of wafer a month. Global Foundries only had 36,000 pieces.
But they got acquired 3 times
more.
Siltera.
Yeah, so in a way, I think the discount was because of a local company. And they wanted to keep, I think, in a way, this national treasure back in Asia. Yeah.
I think for me, a big concern I have is that obviously it's going to be hard to compete with TSMC.
Oh, yeah.
But I've always felt that it would be too difficult for Malaysia with how our education system is set up and also the number of people we have, right?
Correct.
And, why Penang has done so well in, let's say, OSATs or ATEs is because, and for those who listening, ATEs have got people like Vitrox, Me Technovation and all that.
Yeah.
The reason they've done a lot better is because it's a very niche product and it supplies to a, how do I put it? It's too small for big companies, big countries like the US or China or Taiwan. Taiwan is not a big country, but basically China, who they're not interested in that kind of small business.
Correct.
But with Siltera, Wafer Foundries competing with TSMC, they are going into that space.
Yes.
And so it'll be interesting for me to see whether they can actually, look, their number, let's call it Are they even top 10 in your view in the world?
Okay, in their niche, they are considered quite the leaders actually.
I see, okay.
Yeah, so if we were to compare, it shouldn't really be directly against TSMC.
Right.
It should be the guys who are in their niche, which is in MEMS. Yeah.
Right.
Yeah. So they are considered quite the leaders.
Right.
Not really quite the leaders in terms of production volume, but in terms of niche, yeah, they're quite the leaders.
Right. So now the challenge is to increase the production volume, and
they need new equipment, which is very expensive. They need to revamp their plant. They need to increase capacity so that then it becomes a little bit more attractive.
Yeah, I think that will. I think you sum up what I think of the risk as quite well. Which is that a lot of things have to go right now.
900, they have to pump in roughly all in the acquisition cost plus all the capex, opex in about $1 billion. 975 million to be precise, I think.
975 million. And the market cap of Dagang Nexchange is
about 2 billion right
and
now.
The only reason it's 2 billion is because the stock got fried up nicely.
Yeah, exactly.
So yeah, I think that's before we end, I just want to end by saying, guys, this is how this is how we look at things, and sometimes it's just about putting numbers together.
Correct,
right?
correct.
Imagine the amount of risk that Dnax needs to get in order to bring Siltera to a state of the art. Now, is that possible or impossible? No, of course, but there's just a long road ahead.
So much execution risk. Actually, I did a back of envelope, and so right now, DNEX's revenue is roughly about 239 million.
Yeah,
okay?
right.
Trailing 12 months. Net profit was actually in a loss, but then I couldn't. It was in a loss. If you can pull up the numbers, MJ. Yeah, but right now, I just put it at 1 million.
Profit,
right?
they lost 3 million.
3 million, yeah. I put it at 1 right, in this. So I said 2025, which is like 5 years from now. What's the blue sky? In case...
What's the best case scenario?
Yeah,
right?
best case scenario, Siltera goes blue sky, right? Word on the street is that Siltera could probably make about 600 over million.
Right.
Right? So I add that if I sum up DNEX's revenue plus Siltera's projected, I repeat carefully, projected, forecasted, it'll be roughly about 969 million revenue, net profit roughly about 183. We're assuming roughly about 10 to 20% net profit margins, okay? So at a P of 20...
By the way, 20 to 20% profit margin, which I think has not been achieved.
No, definitely not.
Last year in 2020, definitely, right?
Definitely not. Yeah, but this is like what I said, blue sky,
correct,
right?
correct.
Blue sky. At a P of 20, you're talking about market cap of 3.6 billion. So today market cap 2 billion. Upside potential 1.6 billion. Translated to per share basis, there's an upside of 68 cents. And they have to jump through so many hoops.
Correct.
975 million in total expenditure to get it up and running. They have to get the right management team, qualitative wise, execute well all the way. Only then there's an upside of 68%. 68 cents, sorry. So
well, for the nation, we hope they succeed.
Oh yeah, definitely.
So do you have any last points about
No, I
DNEX?
think I wish them all the best. I think I would be very, very heartened to see a Malaysian champion.
Of course.
Yeah. But at the same time, I want the investors to be well aware this is how you should actually look at an investment. Like what you rightly pointed out earlier. Put it into a number, then you can see more clearly in the logic.
All right, guys. Hope you enjoyed this session. It's a good one. And, see you guys in the next one.